read the headline and they say the Federal Reserve just, increased rates by 75 basis points, and automatically the consumer thinks my interest rate on my mortgage that I was gonna try and go get just went up almost 1%.
People get all excited about the headlines. The Federal Reserve is raising 3/4 of a basis point. At least 80% of the market expects that to happen today, all right? Maybe by the time we're done with this, we'll know, in fact, if it did or didn't happen, right? Having said that, the federal funds rate is an overnight rate that banks charge each other, all right? Just an overnight rate. The 30-year fixed interest rate is on the other end of the spectrum. And so there is a trickle-down effect, but it is not that when interest rates go up, the federal funds rate goes up, I should say 75 basis points, that mortgage rates are going up 75 basis points.
Hey, it's Tiffany Holtz. Thanks so much for tuning in today to watch as we speak with my friend Jeff Anklam from Waterstone Mortgage. Jeff's here to talk with us from everything interest rates to home ownership.
In terms of interest rates are increasing. Now, my perception is what a lot of people are concerned about is that this is going to somehow go into a crash because demand is going to go down as interest rates go up. And the reality is that's not necessarily the case. In fact, I would say it's not the case. We all have this recency bias. 15 years ago, our economy crashed, and the housing market caused that. But there's not a correlation of when the economy goes into a recession that, in fact, the housing market crashes. The reason interest rates are going up is because of inflation, all right? So the way I explain this to my customers when I'm sitting across the table from them is their mortgage is like a little black box that spits out $1,000 every month, as an example, all right? If you could have a little black box like that in your basement, that'd be pretty cool, little black box, right? You'd pay somebody some amount of money for that little black box because you get a return on your investment, right? So on the other side of the table, to the banker that's receiving this $1,000 every single month, they don't feel as rich when inflation comes into play. When inflation is running 8.5%, if I'm on this little black box getting a return on investment of, let's just say 4% or 3%, and I'm going to sell this little black box to someone else, they aren't going to pay me as much for it because they can't buy as much with that $1,000 every month return, right? So effectively, the yield is going up. So the market, in fact, these little black boxes are mortgages that get sold on the secondary market from bank to bank, okay? So the market, in fact, sets the interest rate every day. I mean, by the hour, interest rates can change because these little black boxes, these mortgages get sold, all right, back and forth. So the reality is when inflation is under control, that is when you will see interest rates, find a ceiling or not go up anymore, and in fact maybe come down some, all right?
Right, and so we have talked about the fact that we have a lot of clients that are saying, well, I'm just sidelined and I'm not gonna buy a house until I see rates at 2.875, 3% again. And you and I have talked a lot about the fact that I don't know that's a reality.
No, and it's not. Here's what happened when the pandemic started. The market was concerned that, number one, the economy is going to get shut down. People are going to lose jobs. They are not going to be able to make the mortgage payments. And nobody wants to hold a bond that, in fact, is secured by mortgages when the payments aren't getting made on them, right? So they sell them all into the market, meaning there's a huge supply. And effectively, the interest rates go way up. So the Federal Reserve stepped in immediately and started buying all these mortgage-backed security bonds, these little black boxes, if you will, right? And when they did that, it drove the price basically up because they're buying all of them, and the yields down. Now, the Federal Reserve didn't have a mandate for a low interest rate necessarily, but they did have a mandate to keep the mortgage market liquid so that the housing market would stay stable, all right? So when they stepped in, they started buying at a rate of $30 billion with a B dollars per month of these mortgage-backed security bonds. And they have, for the last 2.5 years, done that, which is what kept interest rates really low. Candidly, they did it too long, all right? And you saw demand go up significantly. And it's not that people buy a house because of a certain interest rate, but more people qualify when interest rates are lower than as interest rates go up, all right? So they do that for 2.5 years. They have literally trillions of dollars on their balance sheet, is the way they term it, holding on to these mortgage-backed security bonds. Now, last December, they announced they're going to step out of that market because it's not necessary anymore. And that's when interest rates started going up, and they went up really fast. As fast as when they started buying bonds, interest rates went down. That's how fast they went up. Historically speaking, an interest rate of 6% is normal. We are going back to normal. We are not going to a pandemic that happens maybe every 100 years, which also means we aren't going back to interest rates at a 2 or 3%. It's just not real. It wasn't real. It was manipulated as a function of the Federal Reserve stepping in to basically take care of the housing market.
So we had a lot of people take advantage of those rates, right? And we had a lot of people take advantage of very low interest rates, but at a higher price in housing.
Yes.
The higher price in housing, the two went hand in hand. As people could borrow for less, house prices went up. And so what we're seeing a little bit now is where house prices are coming down a little bit. These interest rates are putting some pressure on that house prices and the affordability of buyers. You know, over the last 2 weeks I've watched, and on average, the price reductions in our market are about 4%, which kind of goes in line with what you see in rental rates. So as we kind of watch that progress, there's a lot of people that, as you said at the onset of this video, think there's going to be a real estate market crash. I don't necessarily think there's going to be a crash as much as there is going to be a little bit of a correction in pricing as we're seeing a correction in interest rates.
Well, here's how it got explained to me, and this makes a lot of sense. If you're driving down the road at 50 miles an hour, and then you speed up to 80, when you come back down to like 50 miles an hour, you feel like you're going so slow. The fact is you're still moving along at 50 miles an hour, right? We aren't going to see housing appreciation that we've seen over the last couple of years in the high teens, okay? Normal number is at a 4 handle, something with a 4 point something in terms of appreciation, okay? So that's gonna feel really slow. I would tell you that it's not gonna be depreciation. Values aren't going down, all right? They just aren't going up as fast as they were. And it feels slow. And it feels, honestly, it's gonna be very normal is what we expect to go to. Your interest rates are at a 5 or 6% are very normal. Appreciation at a 4 point something is very normal. But because it's not 15, 16, 17, 18%, people feel like it's going the wrong way.
Especially if you've only owned a home for a short period of time, right? And this is the only thing you know is that, wow, house prices went up, 16, 17, 20%, and that's the only thing you know. Then when the prices appreciate at 4 or 5% per year, it feels like a stalemate.
Yeah.
And so I think it's just important that we educate people that just like the stock market, you're going to have a really great year, and then the next year it might not be so great, right? It's the same thing with real estate. But one thing that I know in 2 decades of selling houses now is that one of the best hedges against inflation or a recession is real estate.
Yeah, real estate, any tangible asset, all right? And at the same time, you got to live someplace, so you're paying a mortgage. Are you paying your landlord's mortgage, or are you paying your own mortgage, all right? The interest rate on rent is 100%. You got nothing to show for it, right? If your interest rate is 6%, you, at the end of the day, let's say you bought a house today for $150,000 and it never appreciates. In 30 years when that mortgage is paid, you've got a $150,000 asset, okay? What do you have in 30 years if you rent?
Right.
You don't have nothing, right?
That's right.
The average homeowner in the United States has a net worth 45 times the average renter. 60% of that net worth is in the equity in their home, all right? So real estate, owning a home, is how the average person builds wealth in the United States. The reality, that's why there's down payment assistance programs, no money down programs, a lot of ways to help people get into homes. And the reason they do that is because they want you to build your own wealth so that you don't become a drag on, you aren't on the government payroll at the end of the day, 30 years from now. You have built wealth, you've built a life for your family, and that's very important.
So speaking of renting, there's a lot of people that you have helped that have rented for many years and that have, one, either thought they could never afford to own a home, or two, have maybe had some credit issues that were challenges that you've helped them overcome. And I think, again, it's super important that people know what it is that you can do to help them if maybe they have a credit challenge, and how you help them repair that and get on track.
Yeah, so the reality is we're always willing to sit down with someone. We don't just say no, we say not yet, right? Because there are things you can do to get your credit back on track if credit is a challenge or whatever the situation might be. And it might not be today, but you can get there and put yourself in a position to qualify. So we're always more than happy to sit down and help that person understand what the steps are, give them a very direct path that they can follow to get where they want to go.
Right. You've helped lots of our clients, I know, over the years, and there have been people that maybe had a challenge with a foreclosure many years ago, or maybe a credit card they didn't pay off timely, and just helping them understand what it takes to get past those challenges so that they can move on to home ownership is huge. So we really appreciate your help on that.
Well, you're very welcome. We appreciate the opportunity to help anybody we can.
Yeah, thank you so much for coming and joining me. And let's pick up on this conversation in another video.
Sounds great.